ready to start.
Okay.
Well, thank you everybody for attending the webinar today. I am Jennifer Rulins with Fish Property Management. We are a Williamsport-based company providing management and leasing services to real estate investors, allowing them to optimize their returns while reducing their risk. And I am very excited to introduce Bill Goulas of IRA Innovations. I met Bill several weeks ago and was astounded at how expert he is on the topic of self-directed IRAs. Our group today is made up of investors and real estate professionals eager to learn about this exciting topic. Bill, we'll let you take it from here.
Okay, well, thank you very much. Good afternoon, and I want to thank everybody for coming to the webinar today. And I want to especially thank Jennifer Rulings of Fish Property Management for putting this all together. This webinar will last anywhere from 25 to 35 minutes, then we'll take questions afterwards. If you think of a question during the presentation, just type it in the question box. You'll see it right there on your control panel under questions. You can just type it in there, and at the end of the presentation, I'll answer them. Oops, we're not moving. There we go. My name is Bill Goulas, and I've been in the self-directed IRA business for 11 years. I've worked with all types of investors in all 50 states to help them invest in what the industry terms alternative investments, those assets that you can buy within your IRA other than stocks, bonds, and mutual funds. The webinar this afternoon is for educational purposes only. I'm not an accountant, attorney, or financial planner. I do not provide any tax, legal, or investment advice. What we do is educate people on the full breadth of investment allowed by the IRS, some of the restrictions that apply, and those people that the plans can work with. If you're needing financial advice, please consult your legal, tax, or accounting professional. Now, most of you this afternoon are here because you have some interest in residential real estate. Some of you are interested in selling more, and some are interested in acquiring more. The problem is, with acquiring more, is that you're out of money. But what if I could show you a stash of cash you could use to buy more real estate, but that you didn't know you had this stash? Well, here it is. Now, it looks good here on the presentation, but you actually have this stash of cash and are probably unaware of it. It is sitting in your retirement account. Yes, you can buy real estate in a retirement plan. As the slide said, few people are aware that the IRS allows the use of self-directed IRAs to purchase real estate. It's been in most brokerages and mutual fund companies, as it says, are not equipped to deal with the administration of holding such things. But IRA Innovations is in the self-directed IRA business, and we specialize in real estate transactions and the administration of these assets in an IRA account. So what does the IRS say? Well, individual retirement arrangements, or IRAs, were created by an act of Congress with the passage of the Employment Retirement Income Security Act of 1974, or what in the industry is known as ERISA. ERISA allowed people to invest some of their savings on a tax-deferred basis. So before this, anytime you invested money, any returns were taxed at the time. What ERISA did is allowed you to put a certain percent of your money away so that they could grow tax-free, and then when you took it out, you were taxed on it. The Act did not say what you can invest in. It detailed what you cannot invest in. And this is a very short list. And as you can see at the bottom of the screen, if you want to look what we're talking about, you can go to the irs.gov website. So here's what you can't do. You can't invest in collectibles and life insurance. And then the code, the IRS code, goes on to state collectibles is artwork, rugs, antiques, metals, gems, stamps, or coins. However, certain precious metals are allowed. They must be either gold, silver, or platinum American Eagles, or bullion. So South African Krugerrands, Canadian maple leaves, Chinese pandas, those type of coins are not allowed within an IRA, but American Eagles are. Alcoholic beverages are not allowed, and neither is life insurance. And that's it. All other types of investments, including real estate, are allowed within your IRA. So why don't more people know about it? Because after ERISA was passed, banks and brokerage houses did such a good job of marketing IRAs that just about everyone now believes that all you can invest in are stocks, bonds, and mutual funds. Banks and brokerage houses were not and are not in the business of holding alternative assets and are not equipped to hold these type of investments. And according to the IRS, they don't have to. Here's a screenshot of the IRS website, and this is where the link on the slide, 2 slides back, this is where you'll go to. And like I said, you can find this under irs.gov under retirement accounts, investments, frequently asked questions. You'll end up here. And as you can see, the question is, what type of investments can I make in my IRA? We've already answered that. Life insurance and collectibles, and you can see the list here. However, what I've circled makes 2 points. Let me read it to you. IRA trustees are permitted to impose additional restrictions on investments. For example, because of administrative burdens, many IRA trustees do not permit IRA owners to invest IRA funds in real estate. Here's IRA law does not prohibit investing in real estate, but trustees are not required to offer real estate as an option. Let me read that again. IRA law does not prohibit investing in real estate, but trustees, companies that hold the IRAs, such as E-Trade, Fidelity, Merrill Lynch, are not required to offer real estate as an option. Here, the IRS is confirming in black and white, real estate is an acceptable investment within an IRA, but trustees are not required to let you hold it as an investment. So what this basically says is these companies I just talked about, E-Trade, Fidelity, Merrill Lynch, are allowed. IRA Innovations doesn't have any special privileges allowing people to invest in IRAs. It's just that these other companies do not want to be in that business and do not have to be according to the IRS. So that's why you need a self-directed IRA company to hold these type of retirement accounts. We've established what you cannot invest in. So then, what can you invest in? Here is a list, and by no means an exhaustive one, of what IRAs can invest in. As you can see on the left-hand side, starting at the top, real estate. And when we talk about real estate, we're talking about any type of real estate. Real estate that you want to buy and hold, real estate you want to rehab and sell, or rehab and rent. You can do wholesale, you can do lease options, you can do land contracts, you can buy single-family homes, you can buy apartment buildings, you can buy timberland, you can buy subdivision lots. Any type of real estate you can buy within an IRA. Mortgage and unsecured notes, so you can be somebody's banker. You can lend money. If you've got some money in there and you can lend it either on a secured or unsecured note and do it in the terms that you come to agreement with. Tax lien certificates, that's what counties sell all over the country when they're the delinquent property taxes. Private equities, any non-publicly traded company we can hold or you can be invested in. Accounts receivable financing are also known as factoring. We've talked about precious metals, LLCs and LPs, so that you've got a real estate syndication and you can't afford to obviously buy the whole thing, but you can be a part of that syndication. Mobile homes, including both parks and individual homes. You can lend money for auto paper, for somebody purchasing a car, commodity and option trading, joint ventures, and I've got here at the bottom racehorses, and I put that in there because you can do just about anything that you can possibly think of other than what is limited by the code, collectibles and life insurance. However, there are a few rules of the road that we need to go over. There are certain people your IRA cannot do business with. First, you got to understand that your IRA is a separate legal entity from you. It has its own tax ID. So you can think of it as Mr. IRA. And there are certain people Mr. IRA cannot do business with. These people are you and your spouse, lineal ascendants and their spouses, parents, grandparents, children, parents, grandparents, and their spouses, lineal descendants, children, grandchildren, and their spouses. So it goes up and down. Any fiduciary of an IRA, fiduciaries of an IRA would be somebody that holds your IRA, would be a financial planner, maybe even a CPA. Those type of people could be or would be considered fiduciaries of IRAs. Any legal entity, corporations, partnerships, trusts, or estates in which you or any other disqualified person together own directly or indirectly at least 50%. As an example, if you've got a company and you own 25% of it, and that same company, your spouse owns 30% of it, and your IRA wants to work with that company, it can't. Neither of the disqualified individual come up to a 50% ownership, but together, because both you and your spouse are disqualified people, and that percentage now is 50%, that makes that entity disqualified. And then here's where there's some gray area. It's where a disqualified person has undue influence over the affairs of an individual or company. And then as an example here, we're talking about a company, let's say, where I own 20% of that company. And let me give you a real world case. There was a man that owned 20% of a company, and he lent the company money on 3 different occasions from his IRA. Everything was up and up. It was market-based rates. It was there wasn't any excessive interest rates charged or any less than anything market charged. It was it was at a market-based rate, and the payments were made from the company back into the IRA. So there was no disqualification there, where the money went back exactly where it was supposed to be. But the IRS took him to court, to tax court, and at tax court he actually lost. And they were there defending it, saying, well, this individual and any of the disqualified people only own 20% of the company. Yet the tax court ruled that he was disqualified because he happened to be the chief financial officer of the company. And even though he only owned 20% of the company, they said he had undue influence over the affairs of the company, and therefore he was disqualified. So with that tax court ruling, another layer came into as a disqualified person. So you've got to look and see, when you talk about that, if there was any undue influence caused by that. Now, when you work with disqualified people, what results is called a prohibited transaction. In the IRS code, section 4975, it says an IRA cannot engage in any transaction, direct or indirect, with anybody or anything considered related to the IRA. And then when they're talking about related, they're talking about disqualified people. So what happens if an IRA, well, and so the 2 key points here are that there is no self-dealing. Okay, you cannot deal with yourself, and that would create a prohibited transaction, and you cannot receive a personal benefit. Now, what does that mean? Well, if we go back to disqualified people, you notice it was ascendants and descendants, parents, grandparents, children, grandchildren, and their spouses. So that means aunts, uncles, nieces, nephews, brothers, cousins, sisters, and any other type of relative are all allowed. They are not considered disqualified people. However, because you are working with, let's say, a sibling, and there are no, obviously a sibling is not a disqualified person. But let's say you bought a piece of property from your sibling. That's allowed. However, if because you bought that piece of property from your sibling that they may be going through some financial hardships, and so you bought that and you received a personal benefit because now you don't have to support them, the IRS can come back and say, yes, you received a personal benefit and make that a disqualified transaction. Now, what happens if an IRA engages in a prohibited transaction? The IRA is considered distributed to its owner at the time of the prohibited transaction, and at that point there could be additional taxes, penalties, and interest. So what we tell people is that there are so many things you can do and so few things that you can't. It's just best to stay away from things that you can't because you've got so many things that are available to you. So here's some examples of prohibited transactions. Selling, exchanging, or leasing property between an IRA and a disqualified person. We talk about probably, once every 2 or 3 weeks we get somebody calling and saying, I've got my house, can I sell that into my IRA? Well, no, there are actually 2 reasons why you can't. One, you own it. You're a disqualified person. You can't sell it to your IRA because that's, you're buying and selling between a disqualified person. And 2, you're getting a benefit, a current benefit today. You are living in the property, and that's part of the things that are not allowed. You cannot have a current benefit. You cannot lend money or extend credit to disqualified people. Furnish goods, services, or facilities, and that's in reverse too. The IRA cannot contract with somebody that is a disqualified person for services. As an example, a property manager may want to use their IRA to buy a piece of property and then have their company manage it. You can't do that because the company is a disqualified person. Next, transferring income or assets into or out of the IRA to disqualified people. Using the income or assets for personal gain. Obviously, you are going to use it for personal gain when you take it as a distribution. However, you can't take, as an example, you can't take the rental income on a piece of rental property directly and use that. The money's got to go back into the IRA first because the IRA owns it. You don't. And then the use of any property personally by any disqualified person. Always around the beginning of the school year, we get calls from people, usually in middle to late July. It goes like this, it says, my daughter's about to go to college, and can my IRA buy a condo, and she and 3 of her roommates can live there? Obviously, the answer is no, because your daughter is a disqualified person. What if she pays rent? No. She could pay market-based rent. She's still a disqualified person. She can't go in there. Well, what if we collect rents from the other 3 and nobody knows she's in there? Well, you can't do it. The IRS specifically says that is a prohibited transaction. A disqualified person is benefiting from an asset within an IRA today. Completely a no-no. So we very strongly discourage that because it is a prohibited transaction. You can't do these things. So then what types of plans can be self-directed? Well, actually, any type of retirement account can be self-directed. There's really no limitation as to what can and can't be done. ERISA, as we talked about earlier, established traditional IRAs, SEP and simple IRAs. Those were tax-deferred IRAs. Those were monies contributed to those IRAs were not taxed when they were put in there. They were taken out of your ordinary income, so you didn't have to pay taxes on it. So those went in there pre-tax, and so a traditional IRA, you can contribute up to $5,500 this year plus a $1,000 catch-up contribution if you're over 50. SEPs and simples are more in tune with businesses. SEP, self-employment plan, that's what it stands for. Because it's associated with a business, you can put up to $52,000, I believe it is, this year, or 25% of your ordinary income that you receive from the company, whichever is less. So that's a good way to start a retirement plan and to grow that quickly. Rollover IRAs are those where are rolled into actually a traditional IRA from qualified plans. Most people know about qualified plans as 401ks. In the government, their plans are 403bs, that type of stuff. Those can be rolled into IRAs usually after you have left employment with the company. There are few companies that will allow you to do what is called an in-service distribution and roll them out, but not many. And actually, while we're on here, 401ks can be self-directed. It's just that the plan has got to allow it. So if you work for a company, and larger companies, they don't do this. The liability is just too great. That's why they limit you to 4 or 5 offerings, and that's pretty much it. But in smaller companies, sometimes they allow that to happen. And so if you work for a smaller company, you may ask if you can self-direct your profit sharing plan, your 401k plan. In the late 90s, Congress came back and looked at the retirement plans again and said, I think we're going to add one where you can contribute after taxes, and they started the Roth. So Roth's different from the others is that you contribute monies on taxes that you have already paid. And here's the difference here. Traditional SEP simples, those are pre-tax monies, and they're called what are tax deferred. Any income generated by investments in those accounts, obviously you don't pay taxes on until you take the money out. And when you take them out as distribution, it is considered ordinary income in the like W-2 or 1099 income in the year that you take it out, and you pay taxes on it. Now with a Roth, you pay taxes on the contributions before they go in. And again, the limits on the Roths are just like the traditionals. They are $5,500 for each individual, and another $1,000 catch-up contribution if you're over 50. So that money goes in after taxes. You pay taxes on it the year that you contribute it, but then when you take that money out, and any money that those contributions earned, all that money comes out tax-free. So that's the great advantage of a Roth, is that once the money is in there, any gains that you have on that, you pull out tax-free. There are 2 others here that can be self-directed that are really not considered retirement accounts. The Coverdell Educational Savings Account is a plan that you can put away money up to $2,000 for an individual for education expenses, and that includes primary, secondary, as well as higher education expenses. And those again can be self-directed, and then when they come out, they're taxed. They are pre-tax dollars, and they come out taxable. Health savings accounts, you can put money into a health savings account and again direct it as you see fit with as self-directed, and then when those monies are pulled out, they come out tax-free if they are applied to health expenses. And not only so that they come out tax-free, and not only in the year that you have those expenses. For example, you can make contributions to your health savings account, let's say for the next 5 years, and not take any of it out because you want the money to grow, you want to invest it. And then once you've got a pretty good size nest egg, you can come back with your expenses that you had, let's say this year, as long as you keep receipts and stuff, and start taking that money out on health-related expenses from this year, even though you don't take it out for 5 years or from 5 years from now. So that's a great advantage on these health savings accounts. So now we've got a quick pop quiz. Can your IRA purchase real estate? Yes, we have established that that is a valid asset that your IRA can purchase. Can you live in real estate purchased by your IRA? No. The reason is because you are receiving a personal benefit today from assets that are within your retirement plan. Can you personally collect rent for your IRA? No. And the reason is because you are providing a service. We talked about that slide where you cannot provide goods, and disqualified people cannot provide goods and services to their IRA. Now, I get some pushback on this about collecting rent for your IRA. And where we go with this is that, okay, so if you're collecting rent and you're looking at tenants and you're doing the eviction process if they have to be evicted, and you're in charge of getting maintenance crews together when something happens or something breaks at the property. Collectively, obviously, you are providing a service. So we say that if you've got a piece of property that you need a property manager to manage that property because you are providing a service, which is not allowed. So what is the process? How does all this work? And the best way to describe how it works is to go through a simple case study. Let me see how we're doing on time. Okay. So here you can buy real estate with your IRA. Ann Smith wants to use her $68,000 in her IRA to purchase a $58,000 house. So what does Ann do? She's got to set up an IRA with IRA Innovations, and she funds the new IRA. So how does she fund the new IRA? Well, if she's got an IRA at TD Ameritrade, she opens the account with IRA Innovations. We transfer the money from TD Ameritrade to her new account with IRA Innovations. It is not tax reported. It is a non-tax reportable event, and there are no taxes, penalties, interest, anything on there. You just move it over. Ann locates the property, and notice Ann locates the property. It is a self-directed IRA. She goes out and finds the property that she wants to invest in. The contract is initiated in the name of her IRA, IRA Innovations LLC, for the benefit of Ann Smith IRA and her account number. And then IRA Innovations would sign the contract because Ann can't. Ann's not buying it. Her IRA is. And as representatives of the IRA, we would then sign the contract. Then IRA Innovations coordinates with the closing with the title company. The asset is titled. The deed will be IRA Innovations LLC, FBO Ann Smith IRA number 12345. Closing is just like any other closing. The same documents are used. Everything is the same other than how title is taken, because the entity is not the individual but the IRA, and we would sign the documents on behalf of the IRA after Ann has approved all the closing documents. Then once all that's done, funds are wired from the IRA to the title company. Ann does not have to be at closing because she doesn't have to sign anything. She can just go pick up the keys once everything's done. And then the title company the title company would then record the deed at the county courthouse, and basically it's done. So the IRA is now the owner of record on the warranty deed, and Ann left $10,000 in her IRA to cover any expenses. It's important to understand that now the IRA owns the property, and so it is responsible for all the expenses associated with the property. Any income generated by the property goes back into the IRA, rents in this case, and any expenses associated with the property must be paid by the IRA. So Ann leaves a little bit in there to cover expenses. Ann hires Fish Property Management to find tenants and to handle the maintenance. And that agreement between the property manager and the IRA would be signed by the IRA custodian. The property manager finds a tenant. The property management collects the rent and holds the amount they need for escrow, and any extra is sent to the IRA custodian, since the IRA is the owner. Each month, the property manager collects the rent, takes their fees from the rent, pays any expenses, replenishes escrow if needed, and sends the balance to the IRA custodian. Now, let's say after a while the air conditioner at Ann's property needs replacing. Fish Property Management gets a bid and finds a new air conditioner. And then Ann requests payment from her IRA to be sent to Fish Property Management for the cost of the air conditioner. Now notice if Ann set up an agreement with Fish Property Management to receive the funds from the IRA, then the property manager can request payment directly. But there's got to be something sent to the IRA custodian saying this is happening, this occurred, we need money, and that's how that would work. Real quick, going over the next one, we're running up against time here. Here, investing in real estate jointly. And so here you've got Bob and Sylvia. And Bob opened an account, invested a piece of local real estate, and then 6 months later his wife opened her own account with IRA Innovation. So now Bob and Sylvia both have an account here. Bob's got some, he didn't spend all of his money. Sylvia moves her money over here. And together they purchased a property for a long-term holding strategy. They put a contract on a house for $65,000. Bob's IRA is going to own 55% and Sylvia's IRA owns 45%. With closing costs, the total came to $67,823.62. So Bob's IRA sent $37,302.99 and Sylvia's IRA sent $30,520.63. So if expenses are, then income and expenses are paid based on the percentages that each IRA owns. So after expenses and management fees, the total remaining rent each month is $985.50. And then based on their ownership percentages, payments made to Bob's IRA for $542.02 and to Sylvia's IRA for $443.48. And all income goes into the IRAs. They're tax deferred. We talked about that, traditional, SEPs or simples, or in case of a Roth, tax free. And again, all expenses come out of the respective IRAs in the same percentages. So how do you get started here? If that's something you want to do, we've got an application, a rollover, a transfer form, fee schedule. I know a lot of people are going, well, how much does this cost? And a legible copy of your driver's license. Real easy to get started. The application here, it's a 3-page application. The first one, just your information, what you want to do, how you want to open it. Obviously, you need that to get started in everything that you need. All IRAs have beneficiaries. What happens? Who gets this IRA if something happens to you? And that's what this is set up for. And IRAs do not go through probate because they are individual retirement accounts. They have beneficiaries. Now, if there isn't a beneficiary, obviously it would, but there are beneficiaries here, and then the IRA is then passed down to the beneficiaries where they can open an IRA, and the assets that were in the decedent's IRA now go into the beneficiary's IRA. General boilerplate stuff's on it, and it's done. Now, transfers. We talked about transfers earlier, and you can move money between IRAs, between companies, every day of the year. They are non-reportable events. They are non-taxable events. You can transfer between Merrill Lynch and E-Trade, and then from E-Trade to TD Ameritrade, and then from TD Ameritrade to IRA Innovations, and you don't have to bring all the money. You can bring part of the money. So you can leave some to do your stocks, bonds, and mutual funds, and some to do your alternative assets. Easy process. It takes about three weeks to make that happen. And then what does it cost? And what I tell people is, the first year to open an account, get everything set up, fees and all, it runs about $500 when you're buying one asset and you're just holding that one asset. If you're just holding that asset and you don't, you're buying and holding, collecting rents, that type of stuff, each additional year runs about $325, $350. Depends on how many checks are written. So that's pretty much what it costs to get started. And then obviously it's important that you need your driver's license. Got to have that to comply with the Patriot Act and make sure everything, that no money laundering is occurring or any terrorists are using IRAs to fund money. Other than that, it's pretty much set up. It is an easy process. It is an easy way to get assets within your IRA and do things that are set to do it. And I was looking to see if anybody's got any questions, and I don't see anything in the question box, and I don't see any hands up. So let me look and make sure. Oh, there's a question. Jennifer's got a question, so there you go.
I'm muted.
Hi,
There you
Bill.
go.
Let me just get this from somebody in the room.
Okay.
Bill, in the scenario with the husband and wife, 55-45%, can one of them have an IRA and the other not? Can a foreign partnership have this
Okay.
and the other not?
Okay.
Did you hear that, Bill?
I did. Here's the issue on that, and yes, you can. IRAs can partner with any other legal asset, any other legal entity. The problem is that the IRS comes in and says, are you benefiting from it today because you're using money from your IRA to help a disqualified person buy the asset? So if the husband and wife together could buy the asset without using the IRA, then yes, that would work. Obviously, the IRA can partner with any non-disqualified person and buy a piece of property too.
So just more scrutiny.
To what?
Bill, he asked, so there's just more scrutiny in that scenario.
There could be, yes.
Bill, Stephanie's asked, what's the percentage of your fees?
Usually fees are just based on the number of assets, so it's $295 per asset per year. If you've got multiple assets, when you get one or two assets, it's usually less expensive to go number of assets. When you've getting to 3, 4, 5 assets, it's usually less expensive to go value of assets. As an example, if you've got the value of an account from $250,000 to $500,000, it's $775. So obviously, if you've only got 2 assets in there, it's less expensive to go number of assets. If you've got 3 or 4 assets at that price level, it's less expensive to go value of assets, and that's a client election.
Mm-hmm. I would like to clarify one thing, which is there are a significant amount of realtors on the call today, and so when they have a buyer who through their IRA wants to buy a real estate asset, their buyer agency contract would have to be executed by the guardian of their self-directed IRA, correct?
Correct. And it would be correct. And it would be and then the contract would have to be in the name of the IRA.
Okay. Just one moment, Bill. We're getting another question.
Okay.
Mm-hmm. So Stephanie asked a really great question. I'm interested in it too. So we're here in Pennsylvania, and say she wants to buy a vacation property in say Florida. When her IRA buys that vacation property, she cannot go down there for a week and vacation.
That's correct.
Or to do anything to it, to paint it, to clean it.
That's correct.
Mm-hmm. Any other questions?
It is strictly for investment purposes only.
Yeah.
I've got a question. What happens if you rent property to your child? You can't. It's not allowed. The child is a disqualified person, and that would be a prohibited transaction. It has all kind of taxes and penalties and stuff like that. You just don't want to do that.
So many gains. So you make a gain,
Uh-huh.
and it goes back into the IRA, and then there's no tax because it's an IRA.
Yep.
If you decide you want to sell it,
Yeah. Just clarifying, Bill, so on a piece of rental property, the rents will go into the IRA, no taxes are due at that time, and it's time to sell it. We sell it, and the proceeds of the sale will just go into the IRA, correct?
Correct. And again, at the sale, no taxes are due at that time either. The only time the taxes are paid is when you take money out as a distribution.
But there is a law that says as long as it's not your principal residence and you sell a property, you do have a gain.
So Stephanie's questioning and saying, would capital gains not be due because it's not your primary residence?
Correct. No taxes are due because the IRA owns it, and the only time the IRA pays taxes is when distributions are made.
Mm-hmm. Yep. I have a question. So if you're a realtor and one of your disqualified persons, mother, father, son, daughter, want to do this sort of transaction, they cannot represent them in that purchase, can they?
You know, they can't. Usually they shouldn't. They definitely cannot get any commissions off of it. But then there's a question of, even if they don't get commissions, are you providing services to a disqualified person for the IRA? So yes, I'd say no, they couldn't do that.
Okay. One more question. Mm-hmm. Mm-hmm. So I'm not sure how much you know, Bill, about how realtors work, but when they want to personally buy a property, say in New Jersey, what they would do is call an agent in New Jersey and say, hey, I'm not there, will you represent me in this transaction? But in exchange, because I'm a realtor and you're a realtor and I'm referring you my business, that agent in New Jersey would pay them some portion of their proceeds, some portion of their earnings to deal with them. I'm a little confused. I don't know if that exchange of money just cannot happen.
It cannot happen.
All right. Okay, so you can't get a referral fee. And I would imagine the same would be true for any disqualified person. So you refer to another realtor to help your disqualified person.
Yes.
All right. Any other questions on the text questions?
And I'm not seeing any questions from anybody else.
Okay, well that sounds great. I appreciate your time, Bill. A wonderful presentation.
Thank you very much. I appreciate you putting it all together.
All right, well thank you. Have a great day.
Thanks, you too. Bye.
Bye.